What is going on here with the markets? Is it the rates anticipation? Is it the earnings? Is it something else?
So there may be a little bit of a tie into earnings just in terms of the companies that haven't beaten expectations have gotten hit a little bit more. But I think there are bigger picture issues here. It's the combination of the Fed having moved from very loose policy to tighter monetary policy, whether or not what they will start to do with rate hikes, ending tapering, and then potentially moving to QT is the elixir for what ails us in terms of the inflation problem, which in turn is putting downward pressure on growth. And I just think you have a re-rating going on and certainly a bit of a, excuse the term, puking of some of the higher spec, lower quality segments of the market.
So Sarah, puking, a technical term I hadn't heard before, but what are you seeing as an investor? What are you seeing there? What are the opportunities? What are the real risks out there in the marketplace right now?
Well, the market is certainly rewarding certain areas such as energy and financials, banks, insurance stocks, and value indices are outperforming growth by a wide margin. And this is just 3 weeks into the year. But if you look beneath that, as Liz Ann noted, there definitely is pain associated with the extremely high valuation stocks. But not all the very low valuation stocks are doing well. Again, the market seems to be rewarding those associated with rising commodities. And the financials, maybe the value indices are pulling up some of the financials. They have some, I think, serious headwinds. But the area that might have the greatest amount of upside as the market begins to discern the winners and losers in this, as we move toward post-pandemic, will be those that were most badly affected by COVID. And there's a whole range of those stocks that have outperformed thus far and should continue to do so as the year progresses.
Yeah, and David, I think what Sarah said is absolutely right with regard to sort of the push and pull of energy and financials and then the relationship that has with the value indexes. But what's also interesting is a lot of times when people talk about growth versus value and value doing well, they're thinking about it at the index level. But even in a sector like technology, over the past few months, those stocks within tech that screen well on value characteristics like free cash flow yield, dividend yield, are the ones that are outperforming, whereas the stocks within tech that have negative earnings are the ones getting hammered. So even within, call it growthier segments of the market, the value-oriented stocks are the ones that are doing better.
Yeah, we even see this within semiconductors. You can see an incredibly expensive semiconductor stock like an NVIDIA underperform maybe a less expensive stock in memory. So the distinction is happening right before our eyes, and it's a reason to be grounded portfolio-wise in reasonably valued, higher quality companies.
Liz Ann, insofar as there's uncertainty in the market right now, are we going to get some help from the Fed next week? We're going to get another FOMC ruling.
So it'll be an interesting meeting. I don't expect anything particularly formal in terms of what they're going to do. They're not going to start to raise interest rates. Maybe in the statement they give a little bit more color about tapering, but there's no question that during the press conference, I'm sure Jerome Powell is going to be peppered with questions about the span of time between tapering and QT, whether or not they're going to have to act with a faster pace, or a lot of chatter today, might they have to do 50 basis points in the early stages versus only 25. So I don't expect much of any of that to be in the statement, but given that every FOMC meeting has a press conference, those these days I think are even more interesting than what we first hear at 2 o'clock Eastern.
And what we can't, this is so interesting that the Fed, nor can the Bank of England or the European Central Bank, they can't ignore what's right in front of their face, which is inexorable wage increases. That every company we talk to, and companies we don't talk to, we just read transcripts, they are facing wage inflation, and wage inflation begets more. So wage rises beget more wage rises, which was what makes inflation somewhat difficult to eradicate. So central banks may very well be behind the ball here.
Well, I want to pick up on that, if I could, Liz Ann. Inflation could be difficult to eradicate. We know that the track record of the Fed in dealing with this, a soft landing, is not that great. Are we underestimating the difficulty? Because if you look at things like financial conditions right now, they have not tightened that much. If you look at 5 years, they're still around 2.12 or something.
Not only that, but we haven't seen a blowout in credit spreads. All of those would also be the factors you want to keep a close eye on to get a sense of when this is starting to bite to a more significant degree. But you're right, it is always, even in a normal environment, difficult for the Fed to land the plane perfectly, and engineer that soft landing versus a recession. And I think with the added kicker of inflation that's much more rampant and much higher than in the past several cycles, at the same time, we have the virus and the implications that that has had on global supply chains and demand, and how unique the uncertainty is with regard to that. I would argue it's probably even harder for the Fed to engineer a perfect soft landing.
And what's even so fascinating is this is like no other cycle. We've never seen $30 trillion globally of both fiscal and monetary stimulus get pumped into an economy in a year and a half. I mean, that's insane. So that's why it's very difficult for all of us to determine what's next. And all we can do as portfolio managers is ensure we have the best companies we can possibly own for our clients at the most reasonable valuations, because that's where the protection is in a rising rate environment. And then those that are likely to benefit from what has been a very significant setback, namely the pandemic.
Sarah, is cash an alternative right now?
I don't think so. And our clients don't want us to hold cash because there's no return to it. And it may be some time before, after shrinking Fed balance sheets, and maybe then the next step for the Fed is to raise rates. But right now there is no return to cash. And there are markets overseas where the return is still slightly negative.
Lizanne, Sarah makes a really good point. In fact, there's still monetary stimulus going to the economy. They're still buying bonds. They're just buying fewer of them right now. We actually haven't come off of that stimulus yet.
You're right when you look simply at whether the Fed is still adding to the balance sheet. But if you look at a broader measure like M2 money supply, the year-over-year growth rate in M2 actually peaked a year ago and has been coming down quite substantially. So this sort of liquidity drain is not some brand new story. It just becomes more overt when you've got the Fed actually with its balance sheet and rate hikes moving toward tighter policy.